There are 5 things most people believe about investing that are completely wrong. And the worst part? These myths aren't random. They're the exact beliefs that keep people on the sidelines, waiting, hesitating, doing nothing, while their money quietly loses value to inflation. I've been investing for over 10 years, and every single one of these myths I believe myself when I started, or I hear from beginners every single week. So today, we're busting all 5. If you're new here, this channel is built for people who want to understand investing simply and clearly, without the jargon, without the overwhelming information. So let's get into it. Myth number 1. You need a lot of money to start investing. This is probably the most common thing I hear, and it makes complete sense why people believe it. Investing sounds like something wealthy people do, something that happens after you've already made it. But here's the reality. In the UK today, you can start investing with as little as £1. Some platforms offer fractional shares, meaning you don't need the full price of a stock or a fund. You invest whatever you have, even if that's just a few pounds a month. And here's the thing that most people miss. The amount you start with matters far less than most people think. What matters is the habit, the consistency, the time. Someone investing £50 a month from age 25 will most certainly end up wealthier than someone who invests £5,000 once at age 40 and never does it again. Compound growth rewards patience and consistency, not large lump sums. So if you've been waiting until you have enough to start, you can stop waiting. Start with what you have. Start now. The best time to start was yesterday. The second best time is today. Myth number 2. Investing is basically gambling. I understand why this one exists. You hear stories about people losing everything in the stock market. You see the headlines when markets crash. It feels predictable or unpredictable. It feels like a bet. But investing and gambling are fundamentally different things. When you gamble, the odds are mathematically stacked against you. The house always wins. Over time, you will lose. When you invest, you are buying ownership in real businesses. Businesses that employ people, make products, and generate revenue. Businesses that, over time, tend to grow in value. Now, does that mean investing has no risk? Absolutely not. Markets go up, markets go down, individual companies can and do fail. But here's what the data shows. The global stock market, over any 20-year period in modern history, has delivered positive results. Every crash, every recession, every crisis, the market has recovered and gone on to new highs. Gambling is a game designed for you to lose. Long-term investing is participating in the growth of the global economy. Those are not the same thing. Myth number 3. You need to watch the market every day to be a good investor. This one actually causes real harm because people who check their portfolio every day make worse decisions than people who check it once a month. That's not an opinion. That's backed by decades of behavioral financial research. Here's why. On any given day, the stock market might be up or down. If you check every day, you will see losses roughly half the time. And human psychology is wired to feel losses about twice as intensely as equivalent gains. So the more you check, the more anxiety you feel. The more anxiety you feel, the more tempted you are to make a move. And that move, more often than not, costs you money. The most successful long-term investors are not the ones glued to their screens watching every tick. They're the ones who built a sensible strategy, automated their monthly contributions, and then, largely, left it alone. There's a famous study that found the best performing Fidelity investment accounts belong to people who had either forgotten they had the account or were dead. That's an extreme example, but the lesson is real. Set your strategy, invest consistently, then get on with your life. Your portfolio will thank you for it. Myth number 4. To make real money from investing, you need to pick the right individual stocks. This is the myth that loses people the most money because it sounds logical. If you pick the right company, the one that's going to grow, you'll make a fortune. The problem is, almost nobody can do this consistently. And I mean almost nobody. Studies consistently show that over a 10-year period, around 80 to 90% of professional fund managers, people whose entire full-time job is picking stocks, fail to beat a simple index fund. Read that again. The professionals, with teams of analysts, with fancy financial terminals, with decades of experience, most of them cannot consistently beat the market. So the idea that you, as a beginner, with limited time and resources, will consistently identify winning stocks before the market does, is a very, very difficult ask. Now, does that mean you should never buy individual stocks? Not necessarily, but for most people, especially beginners, a low-cost global index ETF will outperform most stock-picking strategies over the long term, with less stress, less time, and lower fees. The evidence is overwhelming. You don't need to pick winners. You just need to own the whole market. And myth number 5. Now is a bad time to invest. Markets are too high. There might be a crash coming. I'll wait until things settle down. I've heard some version of this every single year for over a decade. And here's the thing. There's always a reason to think now is a bad time. In 2010, the world was recovering from the financial crisis. In 2015, China's economy was slowing down. In 2018, trade wars were escalating. In 2020, a global pandemic shut down the world. And in 2022, inflation was at a 40-year high. Every single one of these years, someone was saying, now is a bad time to invest. And every single one of these years, the person who invested anyway is better off today than the person who waited. Now, does that mean you should invest recklessly, regardless of context? No. Sensible investing always considers your personal situation. But waiting for the right time is one of the most expensive decisions most investors never realize they're making. There's a phrase in investing that I think is worth tattooing on your brain. Timing the market beats timing the market. Every time. The best time to invest was always as soon as you were ready, which for most people watching this is now. So there you have it. 5 myths busted. You don't need a lot of money to start. Investing isn't gambling. You don't need to watch it every day. You don't need to pick winning stocks. And there is no perfect time to start. The only thing standing between most people and their first investment is the belief that they're not ready. You are ready. Now, if you want to go from knowing these myths are wrong to actually taking your first step with real confidence, I have built a complete beginner's course for investing beginners. It covers everything from what's good for beginners to invest in, to which investing platforms to use, to a live walkthrough of an opening an ISA and making your first investment from scratch. Simple, clear, built for complete beginners. The link is in the description below. If you found this useful, perhaps think about subscribing and drop a comment below. Which of these 5 myths did you believe before watching this? I tried to read every single comment. But until next time, bye for now.